In this video, I'm going to talk about speed. Nope, not the movie. No, not the drug. I'm going to talk about everyone's favorite kind of speed, acceleration of vesting of equity awards. I'm going to cover some of the key considerations companies need to think about when they are accelerating vesting. The first thing that companies need to determine when accelerating vesting is whether this is a modification of the award. Where the acceleration is a modification of the original terms of the award, that is going to trigger a host of additional considerations to worry about. There are some approval requirements, there are some accounting and tax considerations, and there may be some disclosures to make. Anytime we're modifying equity awards, those modifications have to be properly approved. Under the laws of most states, that means that the modification likely needs to be approved by the board of directors or by a committee of directors, such as your compensation committee. There also can be some very significant accounting consequences. If the acceleration of vesting allows the employee to receive shares that they would have otherwise forfeited, that is going to trigger modification accounting. Now, this typically comes up in the context of acceleration of vesting upon termination of employment. In that case, the acceleration allows the employee to receive shares that they would have forfeited at termination, and the company is likely going to have to recognize some additional expense for the award. If we are accelerating vesting outside of the context of termination of employment, that is going to really get us into a facts and circumstances determination. In many cases, if we're accelerating vesting not in connection with termination of employment, the company won't have to recognize any additional expense for that acceleration. But there are some notable exceptions to this. For example, if we're accelerating vesting in the anticipation that the employee is going to terminate at some point in the future, or if we're accelerating vesting of underwater stock options. In any case, when you are accelerating vesting of equity awards, you do really need to sit down with your accounting advisors, work through all the facts and circumstances, and determine what the right treatment is. From a tax standpoint, if we are accelerating vesting on full value awards, such as restricted stock in units, that is likely to change the timing of when those awards are subject to tax, because both restricted stock and units are typically taxed at vest. That could have some significant cash flow implications for either the award holder or for the company. And if we are accelerating vesting on incentive stock options, it is possible that that could cause the ISO or some of the employees' other ISOs to exceed the $100,000 limitation. Lastly, there may be some disclosures we need to make. Acceleration of vesting can be considered a material modification, depending upon whose equity award we're accelerating and how many employees are subject to the acceleration. Anytime we are materially modifying equity awards, ASC 718 requires us to make some disclosures about that modification in the notes to our financial statements. And if we are accelerating vesting for one of our named executive officers, that could trigger additional disclosures in our proxy statement, in a Form 8K, or in the company's other public filings. Let's go back to our original question about whether the acceleration is a modification. One thing you're probably wondering is, if the answer to this question is no, does that mean I'm completely off the hook for all these considerations? Not so fast. If the acceleration of vesting is required under the original terms of the award, then it's not a modification. But the tax considerations that I talked about likely are still going to apply. It would still change the timing of when restricted stock and units are taxed, and we'd still have to worry about the $100,000 limit for incentive stock options. The rest of the requirements that I went through likely would not be an issue. So that is my quick take on acceleration of vesting for equity awards. We have some fantastic resources on this topic on the NASPP website, including an in-depth discussion of the accounting treatment. We've linked to those resources in the description of this video on YouTube. I hope that you enjoyed this video. If you did, please subscribe to our YouTube channel so that you're notified when we post new videos. Heck, you know what? Even if you didn't like it, subscribe anyway. Maybe you'll like the next one. Thanks for watching.